Hey everyone, hope you're having a good day. My name's Andy. My channel is Finding Value. I've got a question here in the comment section I'll attack. Looks like some people want some information on it. And it is, relevant to a lot of the things going on, current trends or whatever. So let's read through the question real quick and I'll give you my answer. So the question is Andy question. It says, since interest rates on bonds are breaking out, I would suspect the long-term trend is changing to higher rates. What happens to the bond rates if the Fed pivots and begins lowering the Fed funds rate? Will that in turn lower bond rates? Yes, it could. It very well could lower the bond rates in the short term, though. What I'm looking at is the big picture view. So if I were to pull up a chart, let's pull up a chart real quick. We can do this pretty quickly. And we can look at the 10-year yield. So the 10-year yield is this guy. And what's happening is we're breaking out to the upside here for that 10-year yield. Here's the long-term downtrend line. We've got a new shift to increasing interest rate environment. We've broken that to the upside. Now, this doesn't mean that it goes straight higher. This could obviously pull back in the short term before moving up again. Nothing goes up in a straight line. You can see there was multiple pullbacks in the past, in the 1960s and 70s. I think that's going to happen here. We've got a new trend line break. It's broken out. We might even get a retest. That retest could be the Fed funds rate going back down. But it doesn't mean that it will go back to the old trend of literally an interest rate going to zero. The interest rates are more or less a reflection of the market conditions. The market conditions going forward in a highly indebted country is they could get in a positive feedback loop. If interest rates go on up, they have higher interest expenses. Higher interest expenses means that they're going to have to print more bonds, create more money, and more money comes into the system. I know some people say the Federal Reserve doesn't create money. They do, guys. It goes into the Treasury. They get a bond, the money goes into the Treasury then has to do whatever. So I think that in highly indebted countries, what they do is they usually do some sort of quantitative easing. They start manipulating the yield curve and doing all that stuff, which is highly inflationary. It's going to turn out to be even more inflationary. That's my take on it. And I mean, usually when we look at kind of history, usually the inflation is driven by the demographics of that country. Now it's being driven more by the debt, the cycle, the credit cycle, and the end of that credit cycle and the debt in the system. So I think that's going to be the driver of it. Then you've got other drivers that take that money, that inflation. And so the way I define inflation is the money supply increasing. It's different than the CPI going up. Money comes into the system, then that money will be translated into the consumer price index through the shortages of commodities and energy. And we can see those shortages out there. We can see the inventories depleting. We can see that copper's low, silver's low, tin's low. All of these different materials are getting eaten up over time, which will then put a squeeze on the consumer price index down the line. And if you have money coming into the system from that positive feedback loop of interest rates going up, then they're going to try to pull that down. If they try pulling that down, that takes money. That takes money. Money. It's not, I know, oh, well, they don't create whatever. Someone's buying those bonds and someone's getting cash on the other side who's selling those bonds. Cash is going out. So it depends who owns the bonds. If it's commercial banks, then it never leaves the commercial banking system. It's a transaction of a commercial bank selling a bond and them getting cash and having that cash go into the system. If it's an external person or an external entity, whoever it is selling those bonds, then the cash goes into their hands. That is inflationary. That cash came from somewhere. If the cash didn't exist before and they created the cash to cover the interest expense and to cover the bond market selling, if they're trying to do yield curve control, that cash is going to the hands of people. That cash is then rotating into something else. that cash was created from nothing. It is inflationary. That's the way that I view it. You can't be releasing bonds and have no buyers out there and then do QE to buy your own bonds to hold the interest rates down. So where's the cash going? I mean, it wouldn't be, yeah, the cash is going somewhere. Then they would do deficit spending on the back end. The Treasury would do it. Or they would fund government expenditures. It's inflationary. So that's that aspect of it. That's where I'm getting the inflation from. So it's a positive feedback loop of that creation and rolling over Treasury bonds and also creating new Treasury bonds to fund things when you're in a deficit. Going to some of these other questions. Let's take a look. It says, I recently learned that the Treasury will buy shorter. Okay, that's fine. I'm going to skip over that. Can you please comment on the diesel shortage happening in the USA? They say there is 25 days supply left and diesel at over $5 a gallon. Thank you for your channel. So the diesel shortage is inventories getting eaten up, and we have a refining. We haven't built any refining capacity for a very long time. So what's happening is there's people who think that the demand for oil is going to go down. Lots of people think this. Kathy Wood was out there saying that, we've hit peak oil, we've hit peak whatever, peak demand for oil. And we are nowhere near close to a peak demand of oil, in my opinion. So what's happening is we haven't built any new refineries for a very long time. They've done some add-ons, they've increased some capacity here and there, but we are running out of capacity for refining. And that is having an impact on diesel. So yeah, we are eating through our diesel inventories, and those inventories are getting to critical levels. When you hit certain levels, price go vertical. They got to kill demand. And that's happening in everything. Everything, if you look around, it's happening in everything that is commodity related, energy related, commodity related. Uranium's getting eaten up. Copper's getting eaten up, nickel's getting eaten up, cobalt, just go on and on and on and on. Lithium, graphite, go on and on and on. That will be inflationary. That will take the money that's in the system, it's going to rotate it out of bonds and move it right over to the problem. The problem is commodities and energy. Now, what are the impacts of this? This could have some real negative impacts. You start to run out of diesel, how you get stuff shipped around the world. You're going to see shortages of certain things in certain areas. That is the negative consequences of not investing in these things and not having a viable alternative solution to the problems that could potentially happen by not investing in oil and natural gas and pipelines and refineries. It's a balancing act. And the people that are managing it are not managing it well. At least that's my opinion on it. So what you're going to see is you're going to see massive shortages in the future. Massive. Coming out a couple years. And I look at things from a couple years. So what people do is I say this, hey, you're going to see shortages out in the future. And they're going to say, it's not happening right this second. It's going to be normal until it's not normal. And I think it will be inflationary because all of these are the feedstocks of production of goods. I'm in the operations of a lot of these things. So I see the inputs. My inputs are the outputs of everything else. I convert commodities into usable products. If your commodities are short, you think your usable products are going to be short. That is inflationary. You're going to have money rotating out of bonds because of the inflation in the system, and it's going to go into fewer and fewer things because you're producing fewer things. GDP is going to be constrained due to supply chain shortages because mines haven't been built. And even if we build the mines, they have to go into production. They have to go into production. They have to have parts available for things that they need to build in these mines, for the trucks that run and the diesel that they run on, et cetera, et cetera, et cetera. If you're short diesel, you don't have refining capacity, and you're going to have a mining boom, which takes a lot more diesel, a lot more energy inputs, well, we're going to have to figure out solutions to make this all work. That's where the money's going to flow. It's not going to flow to something. It's going to flow to commodities. It has to. because commodities are the feedstock for the things that everybody wants, the wealth that's created from those commodities. So diesel, yeah, it's going to get tight here, and I think it's not just diesel; it's a combination. It's a whole bunch of different things that could potentially go short a few years out. It's going to hit at different times. The investments haven't been made. That's where the money's going to be made, guys. That's my opinion. It really messes up. Precious metals are essential to have, but I'm afraid that our retirement holdings, Canada and USA, will be wiped out or confiscated. Andy, I think you need to take some time to understand why people think crypto assets are another option to hide your wealth. It's becoming a very powerful argument that a global financial reset will steal our wealth holdings, and only place to keep your paper wealth secure is on the blockchain. Many think this is a joke, but the biggest joke of all of this is our bond and equity markets. Nothing's safe, and it's time to consider other ways to protect wealth. Well, here's the thing, all right? This is why I don't like cryptocurrencies. And maybe they work, maybe they don't. Guys, I'm not here to tell you that I know what the future exactly holds. I don't. But I can give you my opinions on why I don't think that's a great store of value. The reason I don't like cryptocurrencies is because it's on the internet. It's connected. It's connected. Maybe it's on the internet. It's connected. All right. When it's connected, they can stop it. They can shut things down. They could stop it through measures or means that they can. So one, you've got a ledger. You can see the ledger. You can see all these transactions that are occurring. They know who transacted what to where. I don't like that. I don't like that. Oh, it's secure. You can steal this stuff, guys. It's not secure. Then you've got the exchanges. The exchanges can be shut down. The exchanges can be stopped. And maybe the exchanges will keep popping up in different things. But, they can do and put regulations on the exchanges. The safest thing is to get your money out of the system into things that people need and want and use. So what's the number one commodity in the world is oil. Now, I don't know how you can directly invest in oil. I guess you could buy a tanker and put it in a tanker or something. But, you don't want to hold oil forever. So silver is an easy way to store wealth. Silver is the number 2 commodity. Silver is what allows us to do so many things in this world. That is the value. The value is in the things that it can produce and create and add value to people. A blockchain and cryptos, and maybe I don't know as much about cryptos as I should. Maybe I know way too much and I don't even need to know about cryptos. Cryptos are a way to transact, but they're not very good at doing that physical transaction. In my opinion, they're not. So they can stop it because you have to have some sort of connection. And they can see the transactions, they can see the ledgers, they can go back and find you. Gold, silver, all this stuff, if you have the number 2 commodity in the world that adds value and utility to society, and everybody wants that, why would they need this? Why would they need Bitcoin? Why would they need to do that? They want your silver. They want your commodity to produce their products, which adds value to society. That is where the wealth is. So that's the way that I view it. Doesn't mean I'm right. Could crypto be a good investment? Maybe. But what is the draw to crypto? What is that draw? A bunch of retail investors seeing it go up a lot? That's the value of it? You have to be able to transact, and it has to be a good one. Now, maybe there are transactions that are valuable to do that. But it's on a ledger. They're going to see it, and they're going to probably tax the living crap out of it. If I hand a piece of gold outside of the system or a piece of silver, how do they transact? How do they follow that? If you go to barter and you're just completely out of the system. I don't know. Maybe there's ways to track that too. I don't know. But I'm not a crypto fan because I don't think they're assets. An asset is something that has value, that people recognize it as value. A house has value because you can live in it. It protects you from the environment. Silver has value because of the value it has in the products that it can create. Oil has value because it is the foundation of the industrial, of industry and building things. It's everywhere. Everything's drenched in oil. That's the value of it. What is the value of a crypto that sucks at transacting and logs all your transactions where you can get caught, and is an energy hog during an energy crisis? So maybe I'm just wrong, guys. Maybe I have it completely wrong. I don't know. I don't see it yet on that aspect. I see the other aspects. I mean, in all honesty, the wealth should be transferred to those that create products and to those that have commodities. Those are the two things that are wealth in society. People are buying this because they think they're going to get rich. But there's no value creation there, and it's not good at what it's supposed to be good at. If you want to be hidden from the system, if you don't want governments to see it, why would you create a ledger? Wouldn't you want something that is basically, you can't track it? But then they're going to say, oh, well, then it's illegal money laundering. It's like, come on. So there's that aspect of it. So let's go down and tackle something else. Coming on down. Zom was kicked out of the Dow Jones. It's fine. I agree that the bull trap is being set, which is definitely will hit equity stocks. How do bull traps affect commodities? Understanding this is relative connection, not 100% decouple. Yeah, so what I think is going to happen is, remember I talk about these shortages that are out in the future? That's going to hit the companies. Why is it going to hit the companies? Because their inputs are all going to go up. The producer price index will go up. Energy crisis impacts it, and all of the inputs for those metals that are going into shortages. So people are going to be competing for commodities, and they're going to be bidding after it, and then the prices go up. So the companies, their margins are going to compress if you can't buy commodities as cheap as they could before. So they're going to have to raise prices, and it depends on if the market can take those price increases. I don't think they can. I think that money is going to rotate towards energy, and it's going to rotate towards all of those aspects that keep life going, put it that way. So food, energy, shelter, those types of things. Less money is going to rotate into companies that aren't at the bottom of that pyramid of Maslow's pyramid. So money's going to rotate over there. It's going to go to that direction. Those are the companies that are going to make the money. And the other companies, like in the tech sector and all that, I don't think they're going to do as well. You don't need those things to survive, and all you need is a certain portion of people to say, I can't afford this. It's cut out. That's your Netflix, your Starbucks, your phones, your whatever it is. And the bull trap is, we've had this kind of first pullback. They usually do a retest move. It could be a double top. It could go up. It's just like Bitcoin did back when it topped. It's the same thing that's happening in the S&P 500. So you're going to see a move on up. You could see interest rates fall. You could see like almost a pause in everything. And what's going to happen is they're going to have to start back up and create more money and loosen up again at some point. Gold is trying to front run that. Bitcoin, I think, is trying to front run that right now in terms of pricing. That's why they're going up. That is another way of front running, or it's a means of front running liquidity. Put it that way. And you want to be invested in these when the beginning of that liquidity movement. So that's why we're seeing the TYX, TNX, and some of these ratios kind of bottom out or try to bottom out and turn around. It's front running the liquidity that potentially could be coming. So that's what they're pricing in. And we could go up to a certain point, but then inflation's going to come right back. And then they're stuck in this inflationary thing, which then they're going to raise interest rates, and you start that cycle again, and you're going back and forth between adding liquidity, taking it out, adding liquidity, taking it out, making sure the system can even survive. And it's being driven by demographics and shortages in the market. It is structural by nature. They can delay things, they can't stop things. It's my opinion there. The houses have to be built if the demographic wants to own homes. Maybe they won't ever own homes. Maybe it'll be structurally more expensive to buy homes. Maybe the affordability will never come back down, or maybe it will not come back down to the level that people think. Maybe it will remain elevated for a very long time. So that's kind of my take on all this. Bonds could go down in the short term. Again, short term, they can have movements. I'm not going to say that they just go straight up. They can pull back. What makes it difficult? What makes these markets difficult is that prices go up and down in an uptrend. They don't just go straight up. They go up, they go back. You get these pullbacks. And everybody thinks that this is a top because you get a pullback. You have to look at the underlying structural moves. What is causing the bond market to go up? Shortages, right? An energy crisis, money coming into the system, combination of all those things. People don't want to hold bonds then. If the bondholders see that there's a shortage out ahead of us in commodities, they may think that it's inflationary movement. Now, inflation is usually a money supply going up. That's what it is, historically. But what translates that inflation into the consumer price index is the commodities. So we need to continue to watch both of those things. Right now, they're doing the Strategic Petroleum Reserve releases. They're holding those commodity prices down in the short term. And Freeport LNG terminal going down. And I know some people are like, oh, well, the European area over there has full inventories. Yeah, it might, but you're going to a flow rate problem then. They use something like 60 billion cubic meters per day, I think. I can't remember what the unit of measure is. It's per day, I think, or whatever. And we can ship 13. 60 minus 13, big gap in terms of flow. So their pricing over there in natural gas is going to be all out volatile as heck. And it's going to be highly dependent on a couple of things. Weather, which is demand, and then your supply. And they could eat through this stuff pretty quick, depending on the weather. So we'll have to watch and see what happens. I don't control the weather. Neither does anyone else. So that's what I've got there for today, guys. If you guys like the content, give me a thumbs up. Subscribe to the channel if you haven't. Check out the Platinum membership, finding-value.com, if you guys want to sign up. We talk a lot about this in the question and answer sessions. We also get into a lot of the companies and how to play it. What are the best companies out there for all of these shortages that are coming up? All right, guys, we'll catch you next time. This is Finding Value.